Right now, there's a thief in your bank account. It's not a hacker or a fraudster, something far more insidious. Every day, your saved money becomes worth less. You can't see it happening. You can't stop it. Most people don't realize they're being robbed. The thief is inflation. Here's simple math. If inflation averages 3% yearly, your money loses half its purchasing power in about 24 years. That $100,000 for retirement will only buy $50,000 worth of stuff when you retire. The money's still there. What it can buy has been cut in half. What is inflation? The general increase in prices over time. A dollar today buys less than a dollar 10 years ago. Your grandparents' stories about quarter movie tickets or $15,000 houses are inflation at work over decades. Why does inflation happen? Most fundamentally, the money supply. When governments print more money or banks create more credit, more currency chases the same goods. More dollars means each is worth less. Here's what matters for you. Inflation is a hidden tax on savings. Keep money in a savings account earning 1% while inflation runs at 3%, and you're losing 2% of purchasing power every year. Your balance grows slightly, while what it buys shrinks faster. Let's make it concrete. Save $1,000 yearly for 30 years in an account earning 1%. You'll have about $35,000. But if inflation averaged 3%, that $35,000 has the purchasing power of only $14,000 in today's dollars. 3 decades of saving and more than half your effort was eaten by inflation. This is why keeping all money in cash or basic savings is a losing strategy. You're not just failing to grow wealth, you're actively losing it every single day. Winners in an inflationary world own assets, real estate, stocks, businesses, commodities. These rise in value with or faster than inflation. If you own a house and inflation runs 3%, your house probably increases at least 3%. You're keeping pace, not losing. This creates fundamental unfairness. Asset owners are protected from inflation. Those with only cash savings are slowly robbed. It's one way wealth inequality compounds. The rich get richer partly because assets appreciate while workers' savings deteriorate. Wages supposedly keep pace with inflation, but often don't. In many countries, real wages have stagnated decades. Workers earn more nominally, but can't buy more. Paycheck numbers get bigger, while purchasing power stays flat. What can you do? Get money out of pure cash into assets growing faster than inflation. For most people, diversified stock market index funds work best. Historically, markets return 7 to 10% annually, well above inflation. The worst thing is ignoring inflation, assuming savings are safe. They're not. Every dollar is melting like an ice cube. Position yourself so assets grow faster than inflation erodes. That's the game.